All right, let's go ahead and get started. Today's class is being recorded. So today is Monday, October 15th, 11 a.m. section. Here is your sign-in sheet. I'm sure you sign this before you leave today. All right, one of the things I thought we would do as we get started is just do a quick check-in on the Bloomberg Trading Challenge. That ends first half Wednesday. Okay. So basically Wednesday around 5 o'clock, I will take screenshots of where everybody stands, and that will be your grade and ranking. Right. Starting Thursday, everything resets. You'll start with $1 million, same teams, same captains, and then you'll do another 6-week sprint. Right, same rules. Got to do 10 new trades minimum. By next week, you'll have to be out of cash. Can't be over 300,000 for the second half of the semester as well. Right? But in terms of where we are today, with 2 days left. Yes.
Could you split the points for each place?
Sure. All right, so this is section 101. All right, so this is where we stand as of today with 2 days to go. Everybody's met the 10 longs, right? You'll have to again do that in the second half of the semester. This resetting to 0. And essentially portfolio value under 300 cash, but this is how you're going to be scored. So if the trading challenge were to end today, basically this team will get 5 points. The next 2 teams will get 4 points, 3, 2, 1. That would be the grade distribution. Okay. So again, relative performance, team in first place is actually doing really well. I think you're actually in first place across all sections, believe it or not. But again, 2 days to go. Right. Questions about the trading challenge? Don't liquidate your portfolios on Wednesday. Okay, if you go to cash, you'll be disqualified. So just assume the trading challenge continues for your purposes for this portfolio. Okay. All right. So that is the trading challenge. Today, I want to briefly go over your homework assignment, which I know was probably a little challenging for some of you. But what you're doing is laying the groundwork and foundations for not only your group project next week, but also for the next section of the class, which will start on Wednesday, which is building valuation models, right? Because essentially what you've laid the predicate for is building a reusable valuation model, okay? And hopefully have a better understanding of how things work when we do that. But again, today, we are going to talk about Southwest Airlines. So under the files folder, under Southwest, I uploaded a solution file. Okay, so if you are looking for a solution, there it is. And you compare your own numbers to that, or if you couldn't get anything to balance, etc., feel free to use that solution file to help you. Okay, so going over the solution file. What I put in here was the TFI balanced, the TII balanced, and the CFI balanced. Right. Before I go through the ROIC tree and the CFI, any questions about those economic statements? If you have trouble getting something to balance, you want to talk about? Hopefully everybody was able to successfully get them balanced. All right, so let's talk about ROIC tree. So once you create these statements, your next step was to go through this end of year ROIC tree for Southwest Airlines, right? Starting with end of year ROIC in 2019, it was 16.1%. 5 years later in 2023, 1.3%. You saw that it fell to a negative in 2020, negative 19.5%. That was COVID. Okay. And the next couple of years kind of recovering from COVID, although again, they're struggling in 2023. Matter of fact, if you follow the continuing headlines on Southwest, I believe this morning, is it Elliott? One of the funds, the predator funds that are targeting them, wants a shareholder meeting with leadership to vote on some additional changes they want the airline to make. And they're also proposing 8 new board seats of board members who want to force changes on the Southwest Airlines. So basically, what they said was just kind of assigned seating is not enough. You have to go further. Right? But regardless, back to our analysis, going from 16.1 to 1.3 over 5 years, that's a 92% drop. Okay. So looking at the first driver, tax rate. In 2019, they paid a tax rate of 22%. In 2023, it's 26.5%. Okay. So that higher tax rate over the 5 years would have led to a partial reduction in the ROIC. It's one of the drivers that caused the ROIC to go down over the 5 years. Right? And you can see the tax rate was fairly consistent, mid-20s over that 5-year period. But the tax rate wasn't the only reason the after-tax ROIC fell. The pre-tax ROIC got worse as well. In 2019, it was 20.7%. By 2023, it fell to 1.7% pre-tax. Again, they took a big hit in 2020 when it went to negative 20%. It kind of recovered in 21, but then kind of backslid in 22 and 23, right? Why was the ROIC going down? Well, driver number 2, operating margin. In pre-pandemic 2019, they're making a 13.2% operating margin. Last year, they made essentially 1 cent, right? And so that 93.5% decline in operating margin, big factor in that ROIC going down, right? But they also saw the operating margin plummet to negative 42% in 2020. Again, that was the year COVID hit. Almost nobody was flying. And they recovered in 21 to 11%. Again, last 2 years, they have been backsliding and struggling. Third driver was productivity. Invested capital to sales in 2019, 63.7 cents per dollar, 2023, 49.4 cents per dollar. Actually, Southwest has been getting more productive and efficient over the 5 years as that invested capital sales ratio went down. Right? Again, it spiked in 2020. All the airlines were grounding their aircraft. Again, people weren't flying. Demand fell by 80% of the airline industry. So that's why the invested capital sales spiked in 2020. But again, the next couple of years, they got more efficient. And again, in 23, they're 22.6% more efficient than 2019, right? But that wasn't enough to offset that 92% drop in operating margin. And so really, it was the margin that was driving the pre-tax ROIC down. Now, what was behind the drop in the operating margin? Now we're going to our second level driver to the income statement. Gross margin in this industry doesn't matter, right? Airlines do not report out a separate cost of goods sold, right? What they do is they combine cost of goods sold and SG&A into one line item, which they call operating expenses, right? So in this model, we're picking up all the operating expenses in SG&A. That SG&A is a combined number for the airlines, okay? Yes. Question? Cyan? No hand? Yes. Oh, thumbs up. Okay. All right. So essentially, gross margin, you don't have to analyze because it's kind of a meaningless number, right? So what's happening here in SG&A is in 2019, their total operating expenses were about 87 cents in the dollar. By 2023, almost 99 cents in the dollar. And in 2020, that was part of the loss because their operating expenses were 153% of revenue, right? Depreciation was about 5.4 cents in 2019, rising to 5.8 cents in 2023. Again, spiking in 2020 as the revenue plummeted to 13.9, right? But really, their operating expenses went up over the 5 years, and that really squeezed their margins, right? What was going on in invested capital sales? Well, as an airline, they had negative working capital, which is favorable to productivity. It was negative 23.8%. working capital sales in 2019, rising to negative 34.4% in 2023. So that negative working capital was favorable to investing capital sales and favorable to productivity. It also spiked very high, 53.9 in 2020. PP&E to sales went from 82 cents, 81.9 to 78.9. Again, driving efficiency of the use of their planes, their gates. Again, spiking in 2020 when revenue plummeted to $1.96. But overall, PP&E to sales got more efficient over the 5 years, and intangible to sales went from 5.6 to 4.9, although it spiked in 2020. Again, not really because they bought somebody, it spiked because revenue plummeted. Okay. That's why I went to 14. But in any event, if you really look at the productivity, the improvement in working capital sales and the improvement in PP&E led to the improvement in invested capital sales. Okay. So summarizing, the big improvements in working capital led to drive invested capital sales going down. Unfortunately, that was offset by a 93.5% plummet in the operating margin because operating expenses went up so dramatically from 87 to 99, which led to the pre-tax ROIC falling 92% from 21 to 2, and with a slightly higher tax rate going from 22 to 26.5, led to the overall after-tax ROIC falling from 16 to 1. That was Southwest. So again, there were two parts to decide. Part number one, there are two parts to this assignment. One is the conversion, make sure we got all the numbers right, and then we had to kind of talk through the numbers and the facts. So, questions about the ROIC tree? Where any of these numbers came from, what they are, or the analysis that I just did. Okay. Part two. Let's hope your part two isn't as bad as the Joker. I saw it got a D on Cinema Score, which makes it probably one of the worst movies ever. Right? So haven't seen it, have no interest in seeing it. Musical, that courtroom, doesn't make any sense. All right. Again, hopefully your assignment did better. So back to this. CFI, make sure you balanced, but ultimately you start with free cash flow. Over the 5 years, Southwest Airlines generated $4.23 billion of positive free cash flow. $8.3 billion coming from gross cash flow from the income statement. They reinvested $4.225 billion back into the balance sheet, giving them $4.1 billion of free cash flow before goodwill. And the investment rate was about 51%. That was the 42.25 divided by the 83.49. So they're reinvesting about half of their profits back into their business. Goodwill and intangibles didn't increase over the 5 years. That went down by 103 million, which is why the free cash flow ended up at 42.26.8. That's another signal that on the ROIC tree, they didn't do acquisitions, right? So even though the goodwill and intangibles spiked on the ROIC tree, it spiked because revenue fell. Okay, you can see on the cash flow statement there was no increase in goodwill in any of the years. So that's another clue that they did not do any acquisitions. Right now, in terms of the 5 years, their gross cash flow in 2020 went negative, right? Because of a $2.7 billion operating loss, giving them an overall gross cash flow of negative 1.5 billion. Recovered nicely in 2021 to 2.5 billion. And as I said, it's been backsliding the last couple of years. Their gross cash flow of 2.5 billion to 1.7 billion as their margins started to struggle in 22 and 23. Okay. In terms of capital investments, capital expenditures, mostly those are buying planes. You'll see that in 2021, 22, they didn't spend much on capital expenditures. No reason to buy planes if nobody was flying in COVID, right? And again, 22 and 23 is when they started substantially increasing their CapEx. 3.6 billion in 22, 3.4 billion in 2023. So almost all that 7.7 billion of capital expenditures has been in the last 2 years. That also led to that CapEx depreciation ratio of 200%, which again, Southwest is planning to grow. All right, they're signaling they're planning to grow. Right, and as a matter of fact, they're biggest barrier to growth right now has been Boeing, right? Because basically all they fly are 737s, and they got a bunch of 737s that Boeing can't manufacture, right? So it's been a problem for the industry, and Southwest has been hurt dramatically by Boeing's problems. Because can't get the planes that they want to grow, which has actually caused further financial stress on them. So in any event, they had 4.3 billion overall of free cash flow. That turned into negative 4.3 billion of CFI, right? How did they do that? Well, mostly because 7.7 billion increase in excess cash. A lot of that excess cash increase occurred in 2020 when they banked about $9.5 billion worth of cash. So as the airline was shutting down, number one, they were limiting some of their expenses, but two, they were kind of holding on to their cash, particularly in that time of uncertainty of COVID. They also did generate 692 million of after-tax interest income, and they did have a $210 million loss. But those non-operating items, most importantly, the increase of excess cash, 7.7 billion, and the increase of non-operating assets by 1.3 billion led to an overall CFI of negative 4.3 billion. Right? So they needed money based on this. Where do they get it? Well, they paid out $1 billion worth of interest expense over the 5 years. Significant increase between 2019 and 2021, from 63.8 to 317. They also increased their debt by about 5.8 billion, the biggest coming during the COVID year of 2020 when debt went up by 8.2 billion. Okay, it paid out, increased their retirement liabilities by about 37 million. And overall, they paid out $988 million worth of dividends. Although they did suspend dividends in 2021 and 2022, and then basically restarted the dividend in 2023 at 428 million. They did issue $2.5 billion worth of shares, including $2.3 billion of shares in the COVID year. And they did buy back 2.4 billion of shares, although again, did not buy back any shares in the last 3 years. So all of those were really pre-COVID share repurchases. So if you kind of look at it overall, the share issue and share repurchase kind of canceled each other out, right? And so really most of that debt in their case was to fund the negative CFI, right? Which really was just banking cash in a time of uncertainty to get through. That would have been your CFI. Yes, sir. Mm-hmm. Yeah. So accounting rule of thumb, okay? The only way goodwill goes down is if it's impaired. So in that case, it's almost like depreciation, just a non-tax item. So therefore, goodwill going down is not a cash flow, and it's just an impairment of what you already have. So the only way goodwill goes up is if you buy new stuff. So an increase in goodwill suggests a cash flow, right? Because if I'm increasing, I paid for that goodwill, but a reduction in goodwill is just a write-off. And so therefore, it's not really a cash flow. And therefore, you know that they likely did not do an acquisition. Now, the better way to do this is to go to the 10K, read through it, see if they did anything. But that's just kind of an accounting rule of thumb you can use here. Yeah. Which, by the way, I'm not doing this to you this semester. So we are making a little bit of a shortcut here around goodwill. Because technically, we're calculating a free cash flow and a negative goodwill. We're adding that to the free cash flow, but that's a phantom cash flow, right? Because if you write off something, it doesn't add to your free cash flow. Right? So if we have negative goodwill here, and we're adding that at the bottom of the free cash flow line, the 103 million, that 103 million is not really cash. Okay. So what we should be doing is we should make that as an equity adjustment. So reduction in goodwill should be an equity adjustment. An increase in goodwill should be a cash flow. But I'm trying to make this complicated model. A couple simplifications here and there aren't going to make too much to your valuation. All right. Any other questions? CFI, ROIC tree, this analysis. Again, I know you spent a lot of time on this one. This was a hard assignment, right? And this is also the predicate, like I said, to future assignments because I struggle with this semester by semester. But again, my view is if I just give you a model that does everything, it'll be a black box to most of you. And you'll have no idea why it does what it does. You throw a few numbers in, you get an extra output, and you're like, oh, it just gives me the output. By building the model yourselves, you understand how things work. And I just think it's a better way to do it. But again, tougher assignment. All right, 1 week from today, you'll be presenting your second group project. It is on historical analysis, and the company is Delta Airlines. So we're going to stay in the airline industry. Okay. I put up this morning the data that you will need to do the Delta assignment. It is in a folder called Delta, and it's called Model Delta Group Project.xlsx. Okay. So if you open that file, what I've given you are historical income statements, historical balance sheet, and change in equity for Delta Airlines. Similar to what you started with Southwest Airlines. Okay. And so here's what you're going to need to do for your group project. Select one of your team members who you think got the model right. Okay. And then reuse that model to do Delta. Okay. And essentially, if they got the model right and everything's a relative reference, getting the data for Delta into the format you need for the group project should be a 5 to 10 minute exercise, right? What you would have to do, because this is essentially an exact match of the data I gave you for Southwest Airlines in terms of its structure, is you basically take your Southwest Airlines model, you come here to the income tab, you rename this file, save as, whatever, Delta project, Delta valuation, and window, go back to the Delta model, income tab, select the whole tab for Delta, copy it, go to your model of the team member that used to be the Southwest model, go to the income tab, select the whole income tab, paste special values. Okay, so don't copy paste, paste special values, right? Because when you go across Excel models, copy paste sometimes gets a little wonky, because what Microsoft will sometimes do is it'll make a link to that other spreadsheet. So every time you open the spreadsheet, it's going to say, where's this other file? Okay, so if you just copy paste special values, you're just copying the numbers. Okay, now if you ever want to copy the formats, paste special values and formats. But when you copy across spreadsheets, I recommend in this class, just copy the numbers. But if you copy row by row, cell by cell, all of those numbers in the structure, then everything will flow through. Okay, so you'll basically copy the income statement, copy the balance sheet, copy the change in equity. And if you got your model right, the ROIC tree will automatically be built and the CFI will automatically be generated and balanced, right? And a good way to see if it doesn't is go right to your CFI. And if your CFI is unbalanced, you know something's wrong, right? But it should be balanced. Like I checked that this morning before I gave you Delta Airlines. Right. So once you have done this, then you're going to do a 10-minute PowerPoint presentation next week on Delta Airlines, ROIC tree, CFI, right? It is up to you who presents. As I said, across your 4 presentations, everyone eventually has to present, but you can decide who is going to present on behalf of your team this time for the group project. Make sure that everything that you need to present is in that PowerPoint file, which need to be submitted by 10 a.m. 1 week from today. Okay. And again, you're now somewhat familiar with the format. 6 teams will present, 10 minutes per team. Doesn't matter what the previous team said, you have to say it, right? And you should all have the same data, right? But regardless, I would say approximately 5 minutes in the ROIC tree, approximately 5 minutes in the CFI. And what I gave you for the Southwest solution is similar to what you're going to need to do for Delta Airlines in terms of beginning and some of the middle and hooking things up. And the only other thing I would say is you got 7 or 8 people on all your teams, which means I do expect some real world context on Delta Airlines when you are going through this for some of those numbers. Questions about your group project for next week? Questions about the ROIC tree? Questions about the CFI? Questions about anything? All right. So next week, Monday, you'll do your presentations. I believe Wednesday or Thursday next week, check the deadline on the ELMS, but the second peer reviews will be due. So basically take the Excel file you submitted last time, add another column for this assignment, put in the percentages 0 to 100. Same rules apply. Okay. If 2 or more people give you a negative peer review, which means less than 100%, then I'll adjust your grade down. It did happen to several students. If you are one of those students, what it practically means to you is you're taking the final exam. Okay. So anybody with a negative peer review is taking the final exam. There were a few people who forgot to submit a peer review for whatever reason. You'll see a -1 by your name. That -1 also says you're taking the final exam. Okay. So don't forget to submit a peer review, even if you think everybody's 100%. Okay. So that's due, as I said, I believe next Wednesday or Thursday, a couple days after the presentation. But submit early, don't miss the deadline. All right. And then what's coming up? Yes, sir. They'll come in late November. So what I do, and it inevitably confuses numerous students. And the problem is, I think, ELMS. I start to use ELMS in a way that it was never designed to be used. And so it actually caused little challenges on the way you're going to track your grades. So let's be explicit. In this class, there's 100 total points across all the assignments. Okay. Your assignment on any individual grade does not matter to me, or shouldn't even to you. But what I mean by that is that, let's say you just blew homework 7, you didn't get anything to balance, you couldn't get to the final, spreadsheet, get anything right, you get a 0 on the assignment. I know you'll be disappointed, but that's only 2 points out of your semester. Theoretically, you could still have 98 other points and you could still get an A in this class. Right. So that's what I'm saying. Like, losing one assignment is not going to devastate you to your total grade. You lose 2 points, so 98 out of 100, but I can still theoretically make an A, even if I bound homeworks up. Right. And so that, whether you take solace in that, that's the point. Because what I'm going to do at the end of the semester is add up all the assignments, the points for all the assignments, and that will equal your grade. Right. Now, right now, there's a whole 100 total points in this class. By the end of the semester, I will probably give 2 extra credit assignments. Okay. And they'll be weekly homeworks, homework 13, 14, or whatever they are, 12, 13. And those will probably be worth a total of 3 to 5 points. Okay. And I say 3 to 5 points because I'm going to kind of use what I won't call it a curve, but I'll kind of see where everybody's grades are by the end of the semester and decide whether I want to do 3 points or 5 points of extra credit, somewhere in that range. Well, let's say I do 4. Right. So by the end of the semester, I do 4. There's 104 total points available across all the assignments. Right. But to get an A- in this class, you need 90 total points. So right now you need 90 total points out of 100. By the end of the semester, it's 90 out of 104. Okay. So the extra credit points just give you more points to make an A. You need 93 points to get an A. So you'll have 104 points, let's say, to get 93. Right. But this is where ELMS will be confused, because ELMS was never designed to have more than 100 points in a course. So what ELMS will do is it's going to give you a percentage of total. So it's going to take 93 points divided by 104, and that's going to tell you you got an A-. Right. But I'm going to ignore ELMS when I submit your grade. What I'm going to do is I'm going to download an Excel file of all the grade book. I'm going to add up all your points, and that will be your letter grade. Okay. So just letting you know That's going to be a little struggle for some of you at the end of the semester because like, oh, I wanted to get an A in this class and Elms is telling me I don't have an A. Why don't I have an A? Right. And the answer is because Elms wasn't designed to do the type of grading that I do. And I had to put a square peg in a round. Right? Just keep track of it. And that's going to be the extra credit. So that's the other point. Let's say you didn't do well in this assignment. Let's say that you do poorly on a group project. Let's say you do poorly on the upcoming midterm exam. You have points to kind of make up for it. Right. And so it's not 1 for 1 per assignment, but there'll be probably 4 to 5 points at the end of the semester that you will be able to get through extra credit. Okay. You also have the homework replacement. Right. So at some point, I'll put up a paper you're going to write, which you have to turn in by December 3rd. We won't apply the homework replacement until December 4th, I believe it is. But the whole idea is you can take any individual assignment. If for some reason you didn't do the Bloomberg certification, I consider you an idiot for not doing it. But if you didn't, then it's your choice, right? But if you didn't do the Bloomberg certification or any individual homework assignment, you can do the assignment replacement, and that will give you the points back. All right. And same thing. Let's say that you are one of the students who missed the deadline. You got a 0 on an assignment and is fretting, oh no, now I got to take the final exam. The assignment replacement is that indulgence to make up for that. So it would give you, let's say you didn't turn in homework 7 and you did the assignment replacement, and that was the only one you missed. You get 2 points in homework 7, and it'd be treated as if you turned it in on time. So you got 2 opportunities to improve your grade. Right. Questions? Any other questions about anything? Yes, sir. There. The assignment replacement is designed to just replace an individual homework. That's all it is. The extra credit are just points that go towards your semester grade, which are universal, that can be used to essentially help your grade for anything. So there's two ways they give you credit. That's why I told you at the beginning of the semester, it's really hard to fail this class. Like if you do the work and you put it in, you're going to get an A or B, right? The only people that fail a class are the ones who don't do the work. Like if you don't turn the assignments, you don't show up, you don't help in your group projects, like, okay, you're going to do poorly. But hopefully I warned enough people to get out of here that the ones that are here are putting in the work. And the reason I want you to put in the work is you're going to learn stuff. I mean, that's just my perspective. Like if you do this assignment, you're going to have a much better idea how CFI works. If you do this assignment, you're going to have a much better idea how the ROIC tree actually comes together. Like that's why I want you to do the work, but that's the whole point. You learn stuff. Other questions? Right. So what I thought we could just do is one more practice of the ROIC tree in CFI, right? Just before we get to next week. It can't hurt. So we're gonna do that in a second. But I'm gonna make one more comment about Wednesday. So Wednesday of this week, we will start the next section of the class, which is on valuation, building reusable valuation models of enterprise DCF for companies. And the only difference is I'll add the words tied to Bloomberg. Okay. So what we're going to start doing on Wednesday, so you'll need your files and Excel. So we're going to heavy Excel work next few weeks. Right. So again, if you don't know Excel, you will. But the whole point is what we're going to do is we're going to take data from Bloomberg, which is where your last assignment and your group project's coming from, in a standardized format. And we're going to forecast financial statements. We're going to talk about how do we forecast those financial statements. So right now, I'll give you 6 years of historical statements. How do we forecast those statements? Those forecasted statements will create forecasted TIIs, TFIs, CFIs, essentially forecasted cash flow. And that forecasted cash flow will give us our DCF valuations, right? And like the work you did for homework 7, we're going to spend 2 weeks in class building that valuation model together, right? So in homework 7, you did it yourself. Starting for the valuation model, I'm going to do it with you in class. So on Wednesday, we are going to start building that model together. Your homework assignment for next Monday is very straightforward. You're going to take what we finish in class on Wednesday and you're going to turn it in. All right, that's it. There's no write-up. You just do what I do in class and turn it in individually. And that's your next homework assignment. So in case you're wondering, like, what's next week's homework assignment? That's next week's homework assignment, right? The only difference is, as of today, I haven't figured out who we're going to value yet. So by Wednesday, I'll figure out who the common company is that we're going to value. We'll start building it on Wednesday, finish it up Wednesday of next week. And then the homework assignments you're going to have is after those two classes, which took us 2 classes to build the model, it will take you all of 10 minutes to do another company. So similar to what you're doing now for your group project. And then we'll just do a lot more evaluations for the next few weeks of the class. That's kind of what we're moving to next. Okay. All right, so let's do an in-class practice. And let's see who will do this. Remember, we did we did in video, right? In class 4. Let's see if I have one handy here. Let's see. All right, so we're going to go through Boeing here in just a second. Those of you watching on video, we're doing the Boeing CFI and Boeing ROIC tree analysis, which are in the files folder in a folder called Boeing. All right, so what I thought might be useful, a little context, what's going on with Boeing. Again, we didn't have time to do an EIC, but if you go to the BICO, it kind of tells you what's going on. Right? And right now, Boeing is having some current challenges in 2024 because they have been having quality production issues for a number of years, particularly with the 737, but also in the 787, which is a big driver of their business. And right now, one of their unions is on strike, basically shutting down their production. They're demanding higher wages. Company's probably going to have to give it to them. And the interesting thing here in the BICO is this line. The company used $1.3 billion in cash for operations in third quarter, leaving a balance of $10.5 billion, close to the roughly $10 billion needed to run the company. That $10 billion needed to run the company is operating cash. Right? And we've been talking about it. That companies know what level of cash they need. It's not zero. And what Boeing is telling investors is they need 10 billion or things are going to start having serious problems in their day-to-day operations. So, you go significantly below that, you go bankrupt. So cash bankruptcy is not zero. So it's a good example of operating cash in the real world, and they're getting really close. So one of the other things they're talking about in the BICO is they might have to raise some cash in the short term because of their losses, because they're pretty much at their operating cash level. And so they're talking about a stock sale right now, right? Which their stock has been depressed. But what's really going on at Boeing, as I said, is their supply chain quality issues. You can kind of see this on EEO. Here, if you go to company specific, you can see that commercial of their revenue is very, very important. Commercial sales are about 34 billion of the company's 78 billion, but commercial deliveries means they build and sell 737s. Well, one 747, they're out of service now, 767, 777s, and 787s, right? And these are the amount that they're expected to manufacture and sell per year. And you can see between 2023 and 2024, there's a drop, particularly of the 737, right? This is what's been hurting the airlines because Boeing's manufacturing problems having trouble getting the planes out. And the ones that they've got now historically in the last few years have had quality issues. So they're trying to fix the quality and they're trying to ramp up production. Right? And you can see the production of 737 is expected to go up dramatically and double by 2027. So the question is, can they do that with quality? And the short-term issues are kind of getting in the way of that. But all of their planes are expected to sell more. And here's the point. If you go down here, you'll see 2 other things. One, they're also selling, we're expected to sell their defense products, F-18s, F-15s, KC tankers, right? So not a lot of increase in the sale of those planes, right? But what matters is down here when you get to backlog. Today, Boeing has a backlog of 4,617 737s that the airlines around the world have ordered for them that they haven't built yet. Think about that. They're building at a rate of 400 a year, and the industry wants 4,000. Okay. And the only other company that can build planes similar is Airbus, and Airbus looks the same. Airbus is back ordered as far as you can see, and they can't make enough planes either. Right. So on the one hand, Boeing has some short-term problems, but that's why the market's not worried about Boeing long-term. I mean, when you look at all the backlog they have in the growing airline industry, they just got to get out of the way themselves and get back to making the planes, right? They can make the planes, they're already sold, right? So they got a lot of future revenue, and that's called backlog. Same thing. There's a huge backlog of 777s and a huge backlog of 787s, right? So that's Boeing's issue. Short-term problems, long-term great market opportunity, okay? So with that context, let's go through their ROIC tree. Anybody want to practice? Since we're recording the video, I'll assume no. All right, so what you should have noticed is their ROIC from -1.9 to -3.2. As I said, these are the challenges Boeing's had in the last 5 years, right? And even through today. Dropping dramatically in COVID to 2020 to -29.3, but basically a negative ROIC all 5 years, right? But slightly more negative in 2023 than 2019. Taxes, you're going to get some weird numbers. Like when companies are losing money, in particular, tax rates are, because we're doing essentially an effective tax rate here, are going to jump all over the place. So negative or 71.8% in 2019, negative 11.8% tax refund in 2023. Okay. Pre-tax ROIC went from -6.8 to -2.9. That actually got better, right? So why did the pre-tax ROIC get slightly less negative, although it did go dramatically negative in 2020, -35.6, because the operating margin went from -2.6 cents to -1 cent. So they did improve the operating margin to be negative, less negative over the 5 years by 61.5%. And in 2020, though, it did spike to 22% negative. Invested capital sales got a little bit more efficient, 38 cents per dollar in 2019 to 34.8 cents per dollar in 2023. Although it did spike in 2020 and kind of to 62 cents and has been trending down ever since 2023. So productivity, better over the 5 years. Operating margin, a little less negative. That's better over the 5 years. That's why the pre-tax ROIC improved. Okay. Now, why did the operating margin get better? Gross margin went from essentially 88.8 cents to 12.3 cents. So they're actually making more in every plane. The problem is the SG&A is spending more to sell them from 8.4 cents to 10.9, and depreciation got slightly better from 3 to 2.4, right? So really it was the improvement in the gross margin which drove the slight improvement in the operating margin, but not enough because those SG&As pretty high, and then depreciation of about 3 cents going to 2.4, which was an improvement to offset the fact they have a negative operating margin. Invested capital sales got better. Working capital went from 5.2 to 5.8. That's a little worse. PP&E to sales went from 17.9 to 5.9. That's better. Intangible to sales went from 14 to 13. That's better. 14.9 to 13.1. So overall, it was really the improvement in PP&E to sales and to some degree a little bit worsening of offset by the worsening of working capital, but the overall invested capital sales went down 38 to 35. Again, 2020 was an outlier year. Things spiked as revenue declined and ship and manufacturing capacity went down to 62 cents per dollar of invested capital in 2020, but improved over the next 3 years. Looking at their CFI. Boeing had negative 18.2 billion of free cash flow over 5 years. It's just a bloody red mess. They had 7.5 billion of negative gross cash flow for their income statement. They reinvested 11.9 billion of gross investment back in the balance sheet. That is a reinvestment rate of negative 160%, giving them free cash flow before acquisitions of 19.3 billion negative. So that's the real challenge, right? They had negative $19 billion worth of free cash flow from operations over the last 5 years, right? Now, goodwill went down by $1.82 billion, giving them overall free cash flow of 18.2 billion. But really, the true cash negative was the 19.3 billion, right? Most of that occurred in 2020 when they had about 17.8 billion of free cash flow before goodwill loss, right? But their free cash flow was negative for 3 years in 2019, 2020, and 2020. It is slightly recovered in 2022 and 2023, right? But really, that recovery is all because of reductions in working capital, right? They had about an $8 billion, $8.6 billion, $8.7 billion improvement in working capital in 22 and 23. So overall, if they don't have the working capital improvements, they're still going to have challenges. You're just not making enough money in gross cash flow to pay for those capital expenditures going forward. That's the challenge for Boeing. But they don't sell planes, can't deliver the planes, can't get the gross cash flow. So how did 18.2 billion of negative free cash flow turn into negative 26 billion of CFI? Well, $3.3 billion of operating gains helped them, 3.4 billion. But they put in 7.9 billion increase in excess cash and negative 3.3 billion increase in non-operating assets. So here's the point. Most of that excess cash was banking 16 billion in 2020, right? So it's almost like Boeing knew the turbulent times ahead, was trying to preserve as much cash as it could because it had to A, get through COVID, and B, get through its manufacturing issues, right? And then where did the cash come from? Well, 3.4 billion paid in interest. 9.5 billion paid in interest. $40 billion in new debt. They issued about $15 billion of debt in 2019 and 36.4 billion in new debt in 2020. So basically, COVID hit, they loaded up on the debt, right? And they put most of the cash actually in the piggy bank, right? But nonetheless, in you look at dividends, 5.8 billion of dividends. They suspended the dividend in 2021, haven't paid it since. Share repurchase, they haven't bought shares since 2020. So unlike other companies, as their stock price was falling, Boeing is not buying back the stock to basically preserve it. Boeing is taking the cash, putting it in the bank because it knew it needed to fund its way through its troubled times. And even today, it's down to essentially close to zero in cash because it's hitting its operating cash target. So looking at these cash flows, that's why Boeing is probably going to do some sort of, stock issue. And the reason they're doing a stock issue is it's probably a predicate to issuing debt. Because the bondholders are like, look, if you want us to put money in here, we probably want to see some more equity in here, right? So it's probably a combo raise that they're going to ultimately try and do to get through the trouble. But you can see when we say troubled times, what their numbers are playing out with, right? The only difference is the future's as bright as you can see. That's why people are not too worried about Boeing, because if they can get back on the upswing, then the market's there. Matter of fact, if you go to, this is what we're going to start getting into in valuation. So even though this is a really tough company to value, maybe we should do this as our valuation. If you look at ANR, sell-siders are fairly bullish. 20 buys, 10 holds, and 3 sells. 31.5% 12-month upside in the share price. Okay, because you go from less bad or more bad to less bad, that's still an improvement. Okay, and if you look at their EEO in general, if they actually do get those planes delivered, their revenue grows from 78 billion last year to 110 billion by 2027, and their EBITDA goes from 1 billion to 12 billion. Okay, so the market is clearly expecting Boeing to turn it around on a profit basis over the next 5 years. But as I said, they got to get through those manufacturing challenges that they're currently having, their quality issues that they're currently having. Questions about any of this? So when I say context for Delta Airlines, I know you only have 10 minutes. We can't go through everything that I just did with Boeing, but you got to slip in a few things about what's going on with Delta, as opposed to just walking through the numbers. Next one. Okay. Where's the sign sheet? Make sure you sign the sign sheet before you leave. Otherwise, I'll see everybody on Wednesday, where we'll start valuation.